So hello, everyone. It's really great to be here. I'm really grateful to Volker and Katja for organizing this conference. What I have noted many times over many years is the dearth of interactions between economists, especially monetary economists and legal scholars. And finally, I feel like the ice is breaking. That just becomes so plain obvious that we have to start talking and thinking hard about these issues. And it's fascinating, how can that happen? The monetary economists have been talking for decades. I mean, since I was, a young person with no gray hair, talking about central bank independence, but there were almost never legal scholars in the room in any of those discussions. And so questions about, well, what does the US Constitution have to say about this? That seems so obvious to me now, like that should be part of the conversation. We believe in rule of law, and so the extent to which the way Britain works, the way that Germany works, the way the EU is structured, okay, those are important. And it was just absent from a lot of the conversations. And now finally, as I say, the ice is breaking. There's a deeper problem here, which I want to flag, because it's also something I became aware of in my work at the Fed, and it's come up many times in conversations with scholars and policymakers at the IMF. And by the way, these remarks today are only my own views, so please be clear about that. The problem of groupthink is so endemic to human behavior. We like to just get together with a group of friends and colleagues and old buddies that pretty much all agree and who share similar assumptions. And it's harder to get together with people who come from different backgrounds. The whole problem of jargon means that people who know you well understand it. And anyone outside that group, well, too bad. They don't belong here. If they don't know what we're talking about, that's their problem. Okay, talking in general terms that can be understandable to a broader audience is part of how you break the groupthink. And so I think part of the challenge here on both sides, legal scholars and monetary economists, is to broaden the conversation in ways that we can really honestly engage with each other. Another thing is it's difficult to hear criticism. It's difficult to hear different points of view, to say, well, I'm not sure that assumption's right. And it's important. That's how you've got to break the group. We have to break the groupthink. So I applaud Katja and Volker, and I hope that we see a lot more of this. Jill, I know you've been involved with a lot of this, and I'll just say we need more of you. Okay, I was just checking. Jill won this award a couple of years ago for her amazing scholarly work. And it wasn't even getting into the questions about administrative state. It was about all of her other contributions over the years. So, that work I think is still pretty new, right? In your, scholarly career. So we need more of your insights into this. So let me just say one more thing before we go to the slides, which is I'm often wrong. So anything I say today, just take it with a grain of salt. I'm just trying to help foster a conversation here on really complex, tough issues. I've thought a lot about it, so I'm willing to share some ideas, but with hopefully some sense of humility here that I have a lot to learn from all of you. And I'm really excited that we have a whole day together today and tomorrow to learn from each other, engage with each other. And this won't be the end. We're not going to answer all the questions. I'm sure, Katja, you know that, right? We're not going to have everything solved nice and neat by noon tomorrow. This is just, a process here of engagement and trying to tackle really important, complex issues. Okay, so I want to start, because I'm an economist. That's my training. Well, how do economists think about this? And I would say that unfortunately a lot of this conceptual background has actually been missing from the scholarly work on central bank independence. It hasn't been very visible. It was assumed. When that literature was being developed in the 1980s and early 90s, everyone was just, the monetary economists and others who were working on this, like Ken Rogoff, were all assuming this in the background. It wasn't enough in the foreground, and then kind of faded away and got lost. Okay, what's a principal-agent problem? Principal means there's someone who's in charge. Okay, and they have a job that needs to be done, and it's a complex job, and they'd rather not do it themselves. They may not be capable of doing it themselves. They need to hire someone, engage someone to do it. That's the agent. The principal is in charge. They set the objective. They decide what tools and instruments can be used. They set the constraints. They hire the agent. The agent's accountable to the principal, and that's just the basics of that framework. Now, what's really clear and obvious is the principal has to monitor the agent's performance. They have to keep track of what's going on. They don't just turn the keys over to the agent and do whatever you want now. You understand what I'm looking for here, just go ahead. There's monitoring, but there's also no micromanagement. The whole point of hiring the agent, of engaging the agent, is because it's a complex, hard problem. And that the agent, in principle, should be able to do better than the. Okay, now there's a lot of examples here. I won't go through them except to say that many of these should be very familiar to you. Supervisor has an employee, but they better not be sitting there watching them breathing down their neck as the employee's typing at the screen. We know that's a really bad arrangement. Hospital director as expert in business management, an executive and finance should not be micromanaging the chief of surgery, who's an expert physician. The corporate board is a group of experts, accounting, finance, law, business, and so on. Okay, meeting with the CEO. She's an expert. She's running the company or the enterprise or the nonprofit, and the board is overseeing it. They're responsible for it, but they shouldn't be micromanaging. Okay, these are classic principal-agent problems. Well, what about central banks? Why can't we think about this the same way? It connects to the democratic accountability. It connects to the accountability to elected officials. It's a kind of a principal-agent problem, and so I think we can productively think about it that way, and we should be. Those are the economic tools that economists can bring to the table to say, let's bring this into the discussion. Okay, so when we say insulated from political interference, by the way, that is not a new idea. The founders of the United States, when they were writing the Constitution, were very aware of the history of England and France and other countries where the emperor or the king had misused monetary powers to finance wars and palaces. And so in the US Constitution, very clearly delegated monetary responsibility to Congress, not to the president. Long before, the end of the gold standard or Humphrey's executive or any of these other sort of things, long before, okay, long recognition. Okay, the 1980s and 90s literature on central bank independence has a bunch of assumptions built into it, which were all conventional assumptions at the time, and some of them, sometimes in, say, Ken Rogoff's work, it's transparently there. In other papers, it's kind of in the background. That monetary policy, the central bank's sole duty. It's ironic to me that we talk about central bank independence. The literature was about monetary independence. Why? Because the Bank of Canada doesn't have any supervisory responsibilities. Bank of Japan doesn't have any supervisory responsibilities. Riksbank doesn't have any supervisory responsibilities. At the time, in the 90s, Bank of England didn't have any either. That came later, okay? So the point here is that was what the literature was about. And the Fed was the exception, having a significant role in banking supervision and regulation, but the literature was not about the Fed. It was about the broader issue of central banks as monetary authorities. Okay, clear objectives, single instrument. And the reason I emphasize this to you is because everything here, all those assumptions have changed in the last 15 years, sometimes very visibly, sometimes quietly. But then we have to go back to square one and say, okay, well, if that's, and Jill, I thought your remarks are amazing because it's different context, but same kind of issue, okay, that if you made a bunch of assumptions and you reach a conclusion on those, and now those assumptions no longer hold, then you got to go back and revisit, okay? Okay, so I'm going to run out of time here, right? How much time do I have left? A few more minutes? All right, just give me what?
10 minutes, that will be great.
10 more? Oh, that's a luxury. Right. All right, I can do that. Okay, but you see the point? Okay, I think the point is very clear here. Now, Professor Ising is one of my heroes. Honestly, I'm not saying that lightly. Really, one of my heroes. I'm in awe to be standing up here with him in the front row of the audience. It would be like a dream come true. The question that I wanted to ask him, and which maybe he will be able to discuss at some point during our conference, is, okay, the ECB is now getting close to 30 years old. The Maastricht Treaty was adopted in the early 90s and enacted in the mid to late 90s. You know, what assumptions were made at that time that maybe we need to be rethinking about again? And it would help a lot, I think, if the ECB itself or the experts within the European Union and the European Monetary Union would be thinking hard about this. Okay, the same message is what Jill was saying, the same message is here. Okay, we can't just say, well, that's done forever, we're never revisiting it again. That's a recipe for disaster, because things do change and you've got to keep up with it. And sometimes you know the really important things haven't changed. That's a reasonable conclusion, but it requires some evaluation. And I know that Professor Ising has thought about this a lot, so I'm really eager to hear his wisdom. Okay, now let's turn to the US Constitution. I think Katya said this, and maybe you said it, and I think Joel said it. In the US constitutional design, it's really clear, 3 branches. 3 branches. Every elementary school kid in the United States, learns this in their first US government class. Executive, legislative, judicial. I wasn't really aware of the extent to which that's common across other countries, because many other countries have different systems where it's a parliament, and so I don't. But nonetheless, in the United States, that's the way it is. That's the way the Constitution was designed, and I think the whole issues that Jill was describing of in the 1930s. The United States was facing an existential crisis, literally an existential crisis. The alternative model was the Soviet Union. And there were a lot of educated Americans saying that we should switch. That's the right model, okay? Capitalism has failed, we have to switch to a Soviet system. And Franklin Roosevelt, who came from a very wealthy family and very high educated, and he's like, no, we're not giving up yet. We want to protect the system. We think the US system can succeed. That was the existential crisis. That was what led to really dramatic changes in the way the US government worked, including a bunch of new agencies and new powers for existing agencies, including the overhaul of the Federal Reserve, but lots of other stuff. And to pressures on the Supreme Court that if you don't go along with this, we're going to expand the Supreme Court and you'll be outvoted. And all those things were happening in an existential threat. That's important historical background, because the Supreme Court since then, and especially in the last 20 years, has been starting to say, well, you know what? Now we're almost 100 years later. Maybe we need to get back closer to the original Constitution. If we're not going to change the Constitution, then we need to make sure we're actually following the Constitution. And I think it's a healthy process. Okay, the Constitution says monetary policy is a duty of Congress, not the president. And I was disappointed. Jill, I don't know if you would comment on this, because I like the Supreme Court. I think they're super smart. They're expert, amazingly distinguished experts. But in their footnote, they didn't refer to that. It just seemed to me like the most obvious thing. Article 1 versus Article 2. The take care clause covers lots of other things, but the Constitution says regulate the value of money is a duty of Congress. Now, here's the problem. The problem is that banking supervision is an executive duty. It always has been. Always. When the national banks were created in the 1860s, that was when the Office of the Comptroller of the Currency was created within the Department of the Treasury. And the OCC is responsible for overseeing, supervising, regulating the national banks. when the Federal Reserve System was created in 1913, there's a clause in the Federal Reserve Act that specifically says nothing in this act shall be understood as diminishing the powers of the Secretary of the Treasury, and particularly with respect to banking supervision. So it was understood from the beginning to the end that this is in the executive branch. Now, the questions about SEC are a little more complicated, but OCC and banking supervision, that's clearly executive branch. Now, what happened in 2025 when President Trump came into office, he said, that's the way we're doing it now. And so Vice Chair for Supervision Michael Barr stepped down, and President Trump nominated Mickey Bowman as the new vice chair, and she's been there now in that role for the last year, on the understanding that the Federal Reserve's banking supervision and regulation has to be ultimately directed by the White House. Why? Because that's the US Constitution. We may not like it, we might want to amend it. I guess we could try to persuade 2/3 of the states to adopt an amendment, to insulate banking regulation from the executive branch. But in the Constitution as it is right now, that's clearly part of the Take Care Clause. And even the Federal Reserve itself has acknowledged that. There's some other issues here I'm gonna have to skip over. I'll hit my 10 minutes here. The Constitution also gives Congress responsibility for all public spending, revenue, and debt. The key of the Supreme Court decision that Jill was referring to here, and what's really different in the last 5, 10, 20 years than had been the case for many decades, is this non-delegation doctrine. Basically, that if monetary policy is a duty of Congress, it can't just give that away. It can't give it away. It can't abdicate it. Congress cannot pass a law to say, well, we're joining the ECB, we're joining the European Union, we're delegating monetary policy to Europe. They can't. I think the Supreme Court say, no, that you can't do that because it's a constitutional duty. You can't delegate it to the President of the United States. If Congress passed a law to say, we're now designating the President of the United States as the head of the Federal Reserve, most likely the Supreme Court saying, you can't do that. That's a violation of the separation of powers. There's limits under the Constitution of what Congress can do. Now, here's the problem, fundamental problem, which is that if monetary policy is a duty of Congress and it can't abdicate it, it's the principal. Federal Reserve is the agent. How is that power being delegated? And I think that question urgently needs to be considered. I think the real problem here is that Congress has basically abdicated. It's not overseeing in any meaningful way. It gave a mandate of maximum employment price stability. It's given effectively an unlimited toolbox to the Federal Reserve. It's like a boss saying to the employee, go ahead, do whatever you want, just, I'll see you in a year. If you want to write checks exceeding the value of our company, go ahead, that's totally up to you, I trust you. That would be a pretty irresponsible boss. The principal agent problem says the boss has to monitor the agent. The boss has to set clear objectives. The boss has to set constraints. And so when we talk about central bank independence, we should not be talking about autonomy. We should be talking about a central bank that's an agent of elected officials and ultimately accountable to the public. Then the objectives, constraints, tools, communications, all are ultimately the prerogative of Congress. In the United States, that's what the Constitution says. And then Congress has to figure it out. The president can advise. I think President Trump has absolutely the right to yell and scream at the Fed and say, I think you guys are stupid, okay? President Obama criticized the Supreme Court. He said some of their decisions were really stupid. We're in a democracy, and it may not be wise for President Trump to do that, but he certainly has the democratic right to criticize the Fed. He is not their boss. Congress is the boss of the Federal Reserve. Congress is the one that should be having hearings and statutes to, and so I think we're, okay, perfect, because I covered everything. There's stuff in the slides that would be interesting to talk about. We have some more time today. But let me just close with the last slide. Okay, these are just ideas. Think of them as grains of salt. Just some ideas. How could we move forward to align the Federal Reserve with the US Constitution? First, split the Fed. Right down the middle. They got 3 buildings. One of them can become the banking supervisory agency that reports to the White House. Maybe Mickey Bowen's the first, head of it, okay, that's accountable directly to the White House. And then what's left is a monetary policy committee that reports to Congress. That would solve this problem right now of the Fed having two different principles that it's reporting on 2 different things that overlap with each other. I think it's a mess. Okay, something has to be done about that. This would be one approach. Another is all the officials who make monetary policy should be officials of the United States. They should all be officials of the United States, appointed by the president, confirmed by the Senate, and as Jill said, with some more clear limitations on removal from office. We can talk about that later. Congress should oversee the Federal Reserve's budgets, its debt issuance, and it should have routine tools like the GAO and Inspector General to keep Congress up to date about what the Fed's doing. So I'll stop there. Thank you.